I'm Nicole Lappin, the only financial expert you don't need a dictionary to understand. It's time for some money rehab. My guest today, Carter Braxton Worth, was quoted in CNBC as saying, "It's official, we are in a bear market." Now, what makes this remarkable isn't what he said, because by now the bear market is obvious. What makes this remarkable is when he said it. He wrote this at the end of February, right after the market hit all-time highs, and just weeks before the big market sell-off in the beginning of March that would kick off the bear market we are in right now. Carter is a legend, an absolute legend in chart analysis, which makes him as close to a fortune teller as we can get on Wall Street. So today we dig into what he's seeing in the charts that signaled the sell-off, what the markets are telling us now post-Liberation Day, and how tariffs might help or hurt key industries. We also dig into why certain defensive sectors might be your portfolio's new best friend, and how even in rough markets, there are smart plays to be made. Carter actually did a really fun show and tell with me over Zoom, and he gave me a live analysis of the market with visuals and charts and all the good stuff. But first, the big picture with Carter. Carter Braxton Worth, welcome to Money Rehab.
Thank you.
Carter Braxton Worth, welcome to Money Rehab.
Thank you.
Okay, let's talk money and what's going on in the markets right now. I feel like I need a Valium. I actually looked in my medicine cabinet and I was like, what kind of relaxing thing do I have here? It is wild sauce.
Yes, volatility be one word to characterize it, but also red, right? So we've had a great market for 3 years. I guess if you think about the last real drawdown was the 2022 bear market. The S&P declined 27%, the Nasdaq 137, and since those lows in the autumn of 2022, for 3 years we've been ascending and ascending aggressively, to the point where, of course, those who get into valuation, we reached just 4 or 5 months ago the highest price to sales ever recorded in the S&P 500 and the Russell 3000. And now, of course, that excess is being expunged.
You actually called the S&P 500 sell-off before it happened in early March. What were you seeing in the markets that made you draw that conclusion?
Well, for starters, you're very kind to invoke or recall a good judgment. I have all sorts of bad judgments, things that go terribly wrong, but
this was a good one.
I'm pleased with this particular recent effort. The principle that informed that decision, basically in December, January, was that the breadth was deteriorating. Now, people say, well, there's always an issue with breadth, which is a way of measuring market health. And so we have had for a long time great marquee names, right? Household names, Apple and Microsoft and Google, and they've even named them a group, Magnificent Seven, right? Have led so much of the equity market, and people, and perhaps rightly so, well, it doesn't matter that others are lagging and not keeping up. As long as these champions are carrying the team, all is well. But usually when you have divergence between the performance of an aggregate, an index, dominated by a few big outperformers, versus the constituents diverging and not performing, it invariably ends with weakness in the index. And what was happening in December, really started in October, is that individual stocks started to put in their peaks. So right now we know that the sell-off in the S&P, it starts at the index level on the 19th of February, only 6 weeks into it. But for instance, the semiconductors peaked in July. Microsoft peaked in August. I mean, individual securities were starting to roll and stall and starting to basically turn over and head lower way before the index. And so, for instance, right now, the index itself is only down, what, 12%? If you were to look at the Russell 3000, it's important to talk about that because that represents 98% of the investable capital in the United States. The S&P 500, obviously not as broad and big. And if you look at that index, the Russell 3000, the entire shooting match, it peaked on the 19th of February, is down 15% or thereabouts. But the median performance of all constituents is down 38, meaning we're well into a bear market. It's been going on for months. And the individual stock or player on the team has been in real trouble. Only now is it coming out at the index level.
So if I could put that
Mhm.
Great analysis into other words. Basically, you were seeing the big components of the index. So if I bought VOO or SPY, which tracks the S&P
Mhm.
500, that was not turning around as quickly as the big companies within the index. So Nvidia, you mentioned Microsoft hit their peaks and then they kind of reverted back earlier than the overall index did. And so that
Yeah.
showed you that the index was next.
It would be like watching a sickness, looking at 100 people in a room, and one person, oh, you don't think anything's wrong, and now everyone's sick. But it turned out, if you look back, wow, that guy was sick 3 weeks ago. She was sick 6 weeks ago. Meaning, it doesn't come out at the aggregate level all of a sudden. It starts slowly. It's under the surface. Individual securities start to underperform, start to roll over, start to stall, start to decline, even as the index goes higher. The principle is this, let me just say it this way. The parts compose the whole. The whole looked okay to the maybe casual observer. We're making new highs in January, February, but the parts were rolling over.
So the individual companies or the big companies are leading indicators to the overall index, what's going to happen there. And the bigger the companies, the more of a reaction that it will have eventually. It seems like those are the earthquakes and then there's the aftershocks of the overall index. Maybe I'm mixing my metaphors here,
Yeah, no, I mean, look, there's so much money in so few names, the top 10 names. Let me put it this way. If you went back to the about 50, 60 years, if you looked at the weighting of the top 10 stocks, and people say, oh, it's so much money and so few to have, but it's always high end, top weighted. So if you go back to the last 50 years, the top 10 stocks are on average 20+% weight, meaning life sorts out winners and losers. It's just the way it is. A small hardware store gets acquired by a bigger hardware store. A bigger, a better a software operator takes over another. We're always going towards bigger things, concentration. That's the way it is. And so the top 10 stocks, whether it was IBM in its heyday or GE or Cisco in '07, top 10 stock always about 20% weight. But what started to happen this go round in the past 18 months is they were 30 and 33%. So much so that now that they're selling off, that's why the market is finally succumbing.
so you predicted that this was going to happen months ago, but now it's almost like an insult to injury reaction with Liberation Day. We're talking on Liberation Day. What are you seeing in the charts right now? Because the market was declining, we were having really bad days, and now this is just like, you know, kick them while it's down.
Yeah, I mean, over time, and everybody knows this, markets go up. There are more Oreo cookies consumed 10 years from now than now, more Gillette razors, more people. There's prosperity, there's growth, and that's figuring out who you are in the market. But if you are a trader and you spend time trying to zig and zag, trying to study sequences, the current sell-off at the index level is highly unlikely to stop here.
Okay, so can we do a little show and tell me what you're seeing? And also, if we can talk through which of the industries you think are going to be helped or hurt by
Sure.
tariffs. You
So
mentioned
that
consumer products like, razors and
Yeah,
Oreo
exactly.
cookies.
And that's a classic playbook. There was an expression, soap and cereal is the most defensive thing. Soap and cereal. And what that means is if you look at companies like Nabisco that sell crackers or Colgate Palmolive, we have 170, 200-year-old companies in this country that literally sell soap, domestic household things, and food products. Now, those are the most defensive things at all. People consider
Like
healthcare defensive.
P&G or
Exactly.
J&J.
Colgate or Clorox or a General Mills cereal or that sort of thing. Healthcare is relatively new. We don't have healthcare companies that are old like that. 150 years ago, healthcare was okay, bite on this stick because we're about to saw your leg off. We don't have anything else to offer you. Point being, they're not defensive pharmaceuticals the way soap and cereal is defensive, classic staples. And you'll see that now in this current drawdown. What is going down not as much? Soap and cereal. That's consumer staples, utilities, very defensive names. And all institutional managers know this. And if you cannot hold cash, if you're concerned and you're selling some Apple or selling some Google or selling some Meta or selling some Tesla, by mandate, you're not allowed to hold the cash. They have cash managers, different product, different things. So that money must go back by the close or the next day by the close. And so you see rotation. It's always a part of markets, and institutional money will rotate to defensive things because on a beta adjusted basis, even if everything goes down, those stocks go down less. And you're seeing it in the market now. I do, if for fun and wanted to share some charts, I might be able to do that, but we don't have to.
I love fun. I love fun charts.
All right,
Let's do
let's
it.
do it. Here's a thing from March 30 saying, look, it's official, we're in a bear market. Just to talk about the statistics. We're worse now, right? We're down 12%. But just to put this in context, this is the performance that we're talking about. The median and mean stock already down 30, 27%. So it was being masked at the index level, right? The index is saying one thing, I'm okay. And so the weak form of analysis in terms of charting and technical is to look at an index. That's like if you went to the doctor, I went, and I walked in, the guy from 9 feet away said, "Oh, you look okay." I do. I look okay, right? But you don't know about my blood pressure, whether I have diabetes or gout or cholesterol. You cannot study a patient by doing that. You have to get in the chair, get in the gown, and then they take your blood pressure and they poke and prod. That's what this is. The weak form is saying, oh, the index is down only 9, 10. That's nothing. Underneath the surface, it's been massive deterioration, and there's more to come.
Would you say that that's like bellwether for the index? Like what you're seeing with the larger decline,
Well,
my
these are
eyes
all the
are
stocks, right? So
terrible.
this is
So
all constituent,
32%. Okay.
32%. And that's as of a week ago. It's worse now, right? So we're firmly in a bear market. There's no way around that. And in terms of duration, just think of it this way: the peak in the market was the 19th of February. But the median stock peaked in October. So that's the bifurcation. Market keeps going, but stock after stock rolling. Market keeps going, rolling. And now what happens is the index succumbs. And so this is but in terms of levels where we might be headed, just probably offer you this if that's any help. There are 3 reference points. It's the 4850 level for those who might wonder. This is what we're targeting. Here is a 10-year chart of the S&P. And the 3 reference points are 1, and this is very esoteric stuff, but there's something called gap theory. And we have one unfilled gap in the history of the S&P on a weekly basis going back 50 years. Those solid horizontal blue lines were dotted horizontal red lines. And once the gaps were filled, they change and they fill into blue. So were we simply to go and fill, all these other ones were red and they've all been filled. We're thinking we will fill that gap. That's at 4850. Now that would be a 21% decline from the peak. That is also, look at this. We've been in a perfectly mathematical 45-degree angle since the bear market low. So you got your COVID bear market, 35%, 2022 bear market, 27%, and we've been ascending beautifully within this channel until we blew out through the top. Highest valuations ever recorded, excess. Price to sales, forget price to earnings, because earnings can be manipulated and earnings have volatility, but sales are sales, top line. No buybacks, no share issuance. We were trading at record high, higher than 2000.com price to sales, and now we're correcting. Were we simply to go to the lower band of the channel where it bounced before to the penny, to the penny, to the penny, that would give you also 4850. And then finally, were we to retrace to the former high. So when you take a look at this, for instance, we have the COVID bear market, and then we have the huge rally, 20 and 21. But where does the 2022 bear market stop? At the former high. Same thing here. We have the 22-25 bull market. You're likely to come back to the former high. All 3 of those reference points, the former high of 2021, the lower band of the channel in which we've been ascending, and the sole unfilled gap all come out at around 4850. And that's 20%, 21 peak to trough. That's nothing. Happens all the time.
So let's double click on fill the gap. What does that mean in the context of where the market is going? You think it has, if it's 20% down, like 10 more percent to go, or?
Well, yeah, we got about 12% to go. I would say 15. That because if the peak February 19th to the fill of the gap, if and as the gap is filled, would represent a 21.25% decline. So we're about midway.
So does that mean we're headed toward a recession?
So the stock prices are a leading indicator. The government knows this. The government includes stock prices in their leading indicator index. Can a sell-off in the market induce a recession? The real message for that is that rates are falling dramatically. And one says, well, isn't that good? Because then you expand the PE multiple. That's the general principle. But if rates are going down for the wrong reason, weakness, economic contraction, or slowdown, as stocks are going down, Meanwhile, while inflation stays sticky, that is not a reason for multiples to expand. Or said differently, there's only two ways the market or a stock can go up. It either you go up because the multiple increases, or earnings increase and the multiple stays the same, right? So valuation wise, if it's a $100 stock and it's earning $10, that's a PE of 10. Either the stock goes to 120, which means now it's a higher PE, the multiple expands, or the earnings come up and then therefore it's cheaper and the stock goes up to keep the multiple the same. There's only two ways a market or a stock goes up, right? Because it expands its multiple or its earnings go up. What is the reason to expand the multiple in a period of uncertainty? It's not. This is a period where multiples contract. And also the denominator, earnings. Earnings are not likely on a growth path here. There's something else coming. And in fact, you're already seeing it in analyst revisions. They're starting to revise down their earnings estimates. So all of it would net out as lower prices, more likely than not, for the general equity market.
But a recession doesn't, even if that comes, doesn't mean we panic. It means double down on strategy, right? Market downturns are not lasting forever. Bad financial choices can, because when you even look at this chart and maybe it goes down over time, like if you draw a line from, where does this start? 2015 all the way to 2025, it's more than a 45-degree angle.
Oh, yeah. Here, why don't we do it? Let's do this. SPX.
Funsies.
We'll do an all data and we'll do it both arithmetic and log. So let's do 50 years for fun. And that will be a long time, but it'll give us some flavor. So there's 30 years anyway. That you can't even see the bear market of 2000, the dot-com 2002 or 2007. The one thing that I would point out, we're going to change this now to a log scale, and I think this will be worthwhile. And take me 1 second to do it. But the market is at its internal trend line going back to 1929. That is a difficult spot. I'll have this up in about 15 seconds, and you'll be able to see what exactly I'm speaking of. Okay, so here comes the S&P on a quarterly basis, going back all data. And when this populates, I'll show you that this is a little bit of a concern as to how much downside there is. And we believe, again, there's at least, okay, ready, 1900. And I'm now pulling up a chart of the S&P, and it's about.
And if you're concerned about this downside, what does that mean for you guys? Are you shorting the market?
Oh, yeah, well, clients, sure. So I have two types of institutional clients, and those are pension plans. Those are long only mutual complexes. Those are hedge funds. Those are family offices, endowments, and then individual investors. Now, this is not random. We reached the highest price to sales recorded, even higher than .com, 1929, March 2000, February 2025. And we have hit our head to the penny at that line. Now, how big a drawdown? Why not 20%? That's garden variety normal. Some people think it's going to be 50. I can't speak to that. I think that's unknown. But I'm very confident in saying that the current sell-off is not likely to just be over.
So where does it go?
Oh, at least 20%. And were you to go to here, we'll do some other channels. Watch this. I might have. Let me try to do this. We'll do it here. Watch this. So were you simply to get down to this is 3,900 on the S&P. And that would represent a peak to trough decline of, were we to go to 3,900, you can do it right here. That would be about 35%. No different than we saw in COVID, no different than we saw in the 2022 bear market. That was down 27. That is garden variety. Perfectly reasonable.
But then in another 20 or 30 years.
Oh, always markets. Now, inflation adjusted is something different. Let's look at that. The S&P right now is now unchanged for 5 years just for inflation. So let's take a look at that, and that will be worthwhile because that tells a story, really how hard it is over time. So we're going to use the Russell 3000. Again, just to make this clear, RAY, ready, DES. The S&P was the Dow when I was growing up, and then it became the S&P. This is the equity market. The Russell 3000 representing 98% of the investable U.S. equity market. So it's the S&P 500 plus the next 2,500 stocks. Okay. And so this chart is going to be the Russell 3000, the true measure of U.S. equities adjusted for inflation. Here we come. And what you'll see now is we'll go to the pre-COVID high. So there's the 2021 peak, and we are now below where we were in 2021. It is 2025. So equities adjusted for inflation are negative since 2021. It's very important if to look in real terms. But anyone who wants to take a 20-year view, I think the single best thing, and everybody knows this, is to be long equities, for sure. You're not going to get a better bet anywhere else.
And how are you populating these charts? This is just a Bloomberg terminal? Just for folks listening at home, we unfortunately can't do this.
Yep, FactSet, Bloomberg. I got a lot of different tools because you need them all to try to do things. But I mean, this is a good and interesting, right? So let me do it this way. And just to make another point, if you look at the Russell IWM, right, that's the Russell 2000 ETF that's so popular and is so used for charting purposes and for investing. The Russell 2000, right, never, here we go, we'll go back to 2019. The Russell 2000 never could make a high. So it too is stuck. It's below where it was in 2021. So adjusted for inflation, the Russell 2000 has lost about 4% a year for the past 5 years. So unhappy.
It is unhappy, but maybe it can get happier?
In time. In time.
So if a listener is looking at this and is intrigued, or listening to this and feels interested in learning more about technical analysis, what's a metric or data point that you think is really helpful for them to understand as a newbie?
Right. So all that it is, if you think you're studying the supply and demand, and that's what you're studying prices. You're not worried about the income statement or the balance sheet. You're looking for flow of money. And so the expression, the smart money, there's no such thing as smart money. There's just big money in any given day that's moving in or out. Sometimes, here, I'll show you. Watch. Let's pick a big, just to show you that there's no such thing as smart money. Let's pick what's a big popular stock? Oh, Microsoft, MSFT, equity, ready? HDS, holders. So here we go. Now, I'm going to do, this is the most recent, ready? I'm going to sort, these are the holders, and this is the latest additions. That's the latest subtraction. So wait a minute. Fidelity has recently sold 14 million shares, and Barclays has sold, and Bank of America sold, and so is JP Morgan, HB. These are huge players. So is that smart money? But wait a minute. Chit to here. Raymond James has just added. BlackRock is added. There's no such thing as smart money. It's the most.
Yeah, but isn't that just a regular cycle of rebalancing?
No, this is in the last 3 weeks. People are adding money. There are always people coming. But what we're trying to figure out, who at any given moment has the most money directed towards a security. And when you see, and this is the only thing that I spend time on, and I would offer this as an answer to your question, study volume, right? The unusual activity. The existentialists would say, the Camus or the Sartre say, existence precedes essence. And in markets, volume precedes price. We're looking for a stock that trades 1 million shares a day, 1 million shares a day, 1,900,000, 800, and all of a sudden it's only 10:30 and 2 million. And then it's 3 million, then it's 4 million, it's only noon. Unusually heavy activity with a move up or down in a stock foreshadows typically a bigger move in the direction of the initial move. Study volume.
I love some philosophy and some existentialism in the midst of market talk. Thank you for that, Carter.
Sure.
Okay, somebody sent me this chart too. We were talking about NVIDIA, because they had great earnings, it went down. Somebody said, well, there's more room to grow because there's more net margin here in NVIDIA than any other Mag 7 company. 56% net margin is incredible. If my company made 56% margin, that would be awesome. So do you agree with this listener who says it has the highest net margin of the Mag 7, so therefore it's not done growing?
Yeah, I mean, that's fundamentals, what I call them. And I started as a fundamental analyst, did that for years. I don't do it at all. There's very little in terms of findings that analysts have any ability to predict. Now, let me show you. Watch this.
So technical and fundamental analysis, totally different. So fundamental analysis would be like margins and revenue and
that's right. You're studying the business versus studying the Here, look at, why don't we do a stock that's starting to fall apart? Google, maybe? I'll show you how price targets change and move. Or Tesla. That's a popular one. We'll do Tesla. Watch. So what you're seeing here, you see the white line is the 12-month price target, and the yellow line is the price. Okay, so just that we have that. And now we're going to look at this. Which one leads which as far as we can? I know it's small, but it's going to be fine. So again, the price is in yellow, and the white is the price target of all analysts. And the high on the street right now is 764 price target, and the low on the street is
764.
and
Who was that?
120.
Kathy Wood?
JP Morgan right here thinks it's worth $120 a share. And
Wow.
Webbush thinks it's worth $550.
And it's like 250 right now.
Okay. But the point is they all have different ideas. But what do we do? But the thought, the premise on Wall Street is that a highly trained, highly educated securities analyst upgrades a stock. It's 100, and they change it to 120 price target, and then the stock goes up in response. It's exactly the opposite. Analysts don't predict and move, they react. So you can see it here. Which line moves first?
Yeah, it's chicken or egg.
Okay, well,
Kind of
but it
vibes.
isn't. It's one way. Ready? The yellow line is the price. So the yellow line starts going up, 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 up here in 20, and then what starts to move afterwards? The white line. That's the price targets. Then the yellow line goes down, and then they start lowering the price targets. Then the yellow line starts going up. The price is up, up, up. And then finally the white line. And now what's happening in Tesla? Tesla's been going down for 7 months, and only now are they starting to lower. Analysts simply react to price. They don't predict it.
Well, isn't consumer sentiment a big part of what they're analyzing
No,
anyway?
they don't analyze sentiment. No, they just analyze sale. McDonald's. You could do it for Chipotle. You could do it for Wingstop. It doesn't matter what it is. Analysts do not move stocks. They react. Here, look at Wingstop. Which line goes down first? The white line is the price target. The yellow is the price. The price drops, then they lower their price target. It's just the way it is. It's no fun. Here, watch one today, Restoration Hardware. Restoration Hardware is plunging. Look at this, down $100. It's a disaster. What did they do? When did the stock peak? You can see it here on my cursor. It peaked in January at 423. When does the white line start getting lowered? Not until March. Analysts react. They just react. I was one of those people, didn't like that. So I got into charts. Charts have their problems too, but not like this. Just don't do this.
So if somebody's listening and they're reading analyst reports that come up on their brokerage app, you're just saying, take it with a grain of salt because they're I
would say this, there is a distinct relationship between the earnings per share and the price per share on any 5, 10-year basis. But there is no relationship on a 3, 6, 9, 10-month basis. And so analysts' price targets, this is a big company. This is Kohlberg Kravis, one of the big. How do we explain this intellectually? It was 100 in the autumn, and then it went to 170, and now it's 100. Was it cheap then and expensive then? And now, but if you look at earnings estimates, watch what the analysts will do. I'll show you. It's not their fault. It's undoable. I used to do this for a living. It's terrible. Just stay away from it. Ready? Watch this. KKR. Okay, guess what? Do you see how the prices come down? Well, we just looked at that. Price is right. Here's the price. Ready? Watch. This is worthwhile. Price has collapsed. Do you agree? Down 40%. The price targets, there's the white line. What's going to happen? They're going to start lowering their price targets. That's the way they do it. They react to price. They don't predict. Analyst reports are fun to read. They're good for long-term investing. But in terms of an analyst upgrade or downgrade or a price target or this quarter, this month, stay away from it.
Whew. This was a great MBA on charting. Thank you, Carter. Can we play a quick game of bullish or bearish? You touched on some of these throughout our discussion, but I'll just do rapid fire.
I'm ready.
You mentioned Tesla. Bullish or bearish on Tesla?
Ready? We'll pull the chart. We'll do it together. But bearish. Tesla's just lost 50% of its value. Tesla has made no progress in 4 years. I'm a seller.
Okay. S&P 500.
Bearish, lower. About to 48.50 or thereabouts.
But for how long?
48.50. I mean, that's
bearish for how long? Like how many years?
Till it reaches 48.50. So another 15%.
How about Meta?
Sure, let's look. Meta. Well, here too, see, the problem with breaking this moving average, let me just put this in context so people can see the SPX. The general proposition is, here's a 5-year chart, right? We're trying to be in bull or bear phases. In a bull phase, you live above a rising 150 moving average. And when it turns over, it's a bullish to bearish reversal. When it turns again, it's a bearish to bullish reversal. Well, the problem here is that all of these stocks are bullish to bearish. They're all rolling over. If you looked at sector after sector, XLK, the moving average serves a purpose, tell you, are we transitioning from something that was good to not good? And Meta, the risk is, right? It's no different. There are bear phases and bull phases. We're breaking trend. I think that a general statement that is worthwhile, I hear, is that there's nothing to be lost by postponing all new buying. If someone's that cost average down every month and plays golf instead, do it every month. But you have to know who you are in the market.
NVIDIA.
I'm
assuming we're going to see the same type of
same thing. Rolled over.
moving average.
Bounces to the penny. Bounces to the penny. Bounces to the penny. But once it's turned and rolled over, something else is afoot. A bullish to bearish reversal.
So that means you're bearish.
Lower. Yeah, bearish. Now, for instance, look at the insurance stocks. Look how good Chubb is. Look how good AIG is. They're very defensive. Look at Berkshire Hathaway. There's a reason for this, right? They're the only thing.
Even with all the insurance craziness and
very defensive.
Fires and disasters.
So a place to hide. There's a good ETF if you wanted to do it's KIE. And that picks up AIG and Progressive and Chubb and Allstate and so forth and so on. And look how good it acts relative to the market.
You mean it's not
well, it's here,
so up and down?
No, it's relative performance. We'll do it this way. Ready? G10. This will be worthwhile. So rate the simple what the most important thing in investing is alpha, right? So if you say, well, I have a stock that's up 9%, I have one that's up 12, but the market's up 20, that's a disaster. You lose your job for that. Might work at the family barbecue. Oh, you're up 9, I'm up 12. But if the general asset class from which you selected the stock is up more than the stock you selected, that's called underperformance, right? It's being in the bottom of the class. We're looking for relative performance. That's what alpha is. And so if I did KIE on the top, this is the insurance ETF, and you did it relative to SPY on the bottom. So now I just showed you. So it's very clear what we're looking at. We're looking at the KIE. All that is, ready, is this. KIE. It's an ETF that does insurance. Here are the members. Everyone knows these names, right? So American International Group, Aflac, Hartford, right? Big names, okay? Brown and Brown. Okay, so that ETF is what we're looking at right there, KIE. But on the bottom panel, it's a ratio, the relative performance. So the simple way to look at it is this. This ETF, all will agree, has not made a new high. But this ETF is making new all-time relative highs. It's outperforming the market. That's what alpha is. So it acts well.
Okay, a few more before we let you go. Although some of these charts make my heart so sad for retail investors because
it'll all work out. What else could we do?
How about Apple getting beat down with the tariffs?
Okay, so Apple I'd nibble, but speaking about alpha, it's worth doing. Watch this. You want to see how bad this has been? Here's Apple on the top, and we'll go back to a 5-year chart. And we'll do Apple's relative performance to the tech sector. Now look at that. This stock, all will agree, has been going up. And it's been going down relative to its sector. So it is a bad pick, right? So if you were hired because you came out of Harvard, Yale, or Princeton, and then you got an MBA, and then you got a CFA and a CPA, and you were hired at Goldman Sachs or Morgan Stanley or Credit Suisse, a big firm, to buy and sell or recommend securities, and you picked Apple versus the tech sector, it's called underperformance. Thanks for playing. Go home. You lose your job. Bad pick. And there it is in black and white. The stock is up, but it's underperforming the other choices one could have made as represented by the XLK, which of course is the tech sector. Relative performance is everything.
How about Nike?
Nike, oh, that's an unhappy. No, that's unhappy. And sometimes this happens. Great franchises, Nike, Disney. It's tempting always to think it's cheap. So Nike is the same price it was in 2015. It's now 2025. So adjusted for inflation, Nike's lost about 40% of its value. And that's a disaster. I wouldn't step in and buy that. Why? Just because it's down? There's no thesis. Just one of the oldest rules in the book. Hard to do. I'm constantly holding my own finger off the buy button. Don't buy stocks in downtrends. Just don't do it.
But what about buy low, sell high?
Yeah, those are idioms and adages that they're melodious. They sound good in the ear, but they're not really real. Stay away from this. I wouldn't buy this. I mean, that's like saying, here, watch this. WBA, Walgreens boots. I don't know. When's it cheap? There's no such thing as cheap. Cheap's a dirty word. It's like an expletive. Walgreens boots is cheap. It's lost. It's over. It's out of business. Don't buy stocks in downtrends. It's a pretty good rule. I struggle with myself. I'm always tempted. This is so cheap. I got to buy it. Don't do it.
So what do you do instead? Is there something that you are bullish on that I didn't mention?
I just showed you one of the great areas of the market. Insurance stocks are fantastic.
Even with all of the craziness in the world and all of the natural disasters.
Yeah, well, there's some are life health insurers. They're not, Aflac doesn't care about disasters. You're talking about property casualty. That's a different kind of thing. But MetLife, Pru, Chubb is, doing insuring antique clocks and that kind of thing. Case by case, they're not all great, but again, this is a very fine area of the market to be in right now if one has to be long.
Okay. Anything else you're bullish on? Just insurance.
Well, I have individual buy and sell lists all the time. I like energy here. I think that's a yield play ultimately. So do it through the XLE or Chevron's a favorite. I think Schlumberger is making a turn. Talk about bearish to bullish reversals. Schlumberger's, we think, on the cusp of turning. It's returned to where it was, given back half of its move from its COVID low. So there's one, but case by case. But we publish them all the time in reports.
So we're talking about traditional energy, not nuclear energy.
No, this is a driller, Chevron. Also, so let's do energy overall. So the sector is only, remember, this is not even a real sector anymore. Maybe it's probably worth, people should look at that and see. Ready? Watch. WEI, you like this, how teeny. It's only 2% of the, okay, ready? And we'll do this by sector. Ready? SPX, index go, MEMB. This will take me 2 seconds. If you look at the weighting, I think it's about 2.8%. Here we go by sector. Okay, so you see here energy, 3.5%. It's nothing. And 2 stocks are half the weight, Exxon and Chevron. So is it even a sector? The entire thing is only 3.5% in the S&P, and 2 stocks are half the weight of the 3.5%. But energy itself, right? Energy was the best performer after being the worst performer. So it was the single worst performer during COVID. No planes are moving, no cars are moving. And it was the single best performer of the 11 sectors on the rebound. But now after 4 years of sideways, our thinking is this is going to ultimately be a place for alpha, right? For relative performance. As other things get worse, this holds steady. That's the premise.
And what about nuclear energy with all of the AI?
Yeah, I don't know.
Compute that we're going to need.
Yeah.
That's not your jam.
I can't think of any nuclear ones to come to mind. I haven't really done any of those, but if you know a name, I'll happily pull it up and we can look.
Like Constellation Energy.
That's CEG. Yep. Well, here too, the breaking of trend is never good. I think this is probably headed to 175. I'd be a buyer there, not here. It's quite a sell-off, huh? 350 to 200.
Money Rehab is a production of Money News Network. I'm your host, Nicole Lappin. Money Rehab's executive producer is Morgan Lavoie. Our researcher is Emily Holmes. Do you need some money rehab? And let's be honest, we all do. So email us your money questions, moneyrehab@moneynewsnetwork.com, to potentially have your questions answered on the show or even have a one-on-one intervention with me. And follow us on Instagram @moneynews and TikTok @moneynewsnetwork for exclusive video content. And lastly, thank you. No, seriously, thank you. Thank you for listening and for investing in yourself, which is the most important investment you can make.
But does it go, how can you look at this chart and assume, well, in 10 years, we're going to need so much more nuclear energy. There's just not enough power to compute. And where does that line go? I mean, that's what makes me so upset at these charts.
That's a narrative that feels good. I mean, whatever, but no one knows that. Here, let me show you this one. Watch this. You like this. Let's do the same thing with ANR. So CEG, equity, ANR. So the analysts, they were confident they wouldn't be lowering, they wouldn't be reacting to the price, right? The stock is dropped from 350 to 190. If you're confident what you did and you have a price target of 400, you'd say buy more. What are they starting to do? Look at the white line. Here it comes. It's going to trail behind. The price is already down to 200. There it is, 200. The yellow line is dropped from 350 to 200. Here it is there. And now what do they start to do? They're lowering their price targets. They don't predict anything. They react. I only know this because I was one of them. Not good. Stay away from that.
I feel even more depressed after we just spoke.
It'll all work out. Buy and hold. Buy and hold works. You just got to have a lot of time on your side.
Money Rehab is a production of Money News Network. I'm your host, Nicole Lappin. Money Rehab's executive producer is Morgan Lavoie. Our researcher is Emily Holmes. Do you need some money rehab? And let's be honest, we all do. So email us your money questions, moneyrehab@moneynewsnetwork.com, to potentially have your questions answered on the show or even have a one-on-one intervention with me. And follow us on Instagram @moneynews and TikTok @moneynewsnetwork for exclusive video content. And lastly, thank you. No, seriously, thank you. Thank you for listening and for investing in yourself, which is the most important investment you can make.